Welcome to the second and final part of our masterclass, Anatomy of Price, Price Action and Smart Money Logic. In the first part, we examined in detail how institutional capital thinks, where it gathers liquidity, and how to identify market structure breaks. If you haven't watched part one yet, be sure to go back and watch it. Today, we're moving on to the most profitable practical application. We'll explore the two primary tools for finding trades. Order blocks and imbalance zones, learn how to conduct top-down multi-timeframe analysis and break down 4 ideal historical trades step by step. Watch this video to the end, subscribe to our channel, and let's get started. Let's move on to the first essential concept in our practical application: imbalance, or fair value gap, FVG. What is it? An imbalance is a zone of inefficient price action. When a large market player injects a massive volume of capital into the market, the price makes a powerful, impulsive leap. On the chart, this appears as 3 consecutive candles, where a blank gap remains between the high of the first candle and the low of the third candle. This gap is the imbalance zone. The market dislikes inefficiency, which is why in 80% of cases, price later returns to this zone to fill the gap before continuing its move.
Trade global markets with spreads from 0 pips and forget about overnight position rollover fees. The swap-free service is designed for long-term strategies and active scalping. All net profit remains in your account. With InstaForex, your trading capital always works at peak efficiency.
The second key element of our setup is the order block. An order block is a specific candle where institutional capital placed its main cluster of trading orders. A bullish order block is the last down candle before a powerful bullish impulse that broke market structure and created an imbalance. Why is this candle so important? Because the market maker's own unclosed losing positions remain inside it. When price returns to this candle, the institutional player defends their level, enters the market in the direction of the main trend, and sends price upward. Before opening trades, remember the golden rule of professionals. Analysis is always built from the higher time frame down to the lower time frame. This is called top-down analysis. On the higher time frame, such as the daily or 4-hour chart, we determine the overall context, where the trend is heading, where liquidity has been swept, and where global order block or imbalance zones are located. On the lower time frame, such as the 15-minute or 5-minute chart, we look for a precise entry point with a minimal stop loss. Never look for an entry point on a lower time frame without understanding the higher time frame picture.
Making mistakes in the financial markets is no longer frightening. The unique risk insurance program allows you to fully protect your deposit. In the event of losing trades, the company compensates for losses. Secure trading and 100% protection begin with an InstaForex account. Follow the link.
Let's analyze our first real historical example. Step 1. Higher time frame analysis. On the daily chart, we see a clear bullish structure. Price makes an impulsive move upward, breaks the high, and leaves behind an unfilled imbalance zone and a daily bullish order block. A few days later, price begins a systematic pullback downward and dips right into our daily order block. This is our primary alert signal. We don't buy blindly right now. Instead, we switch to a lower time frame to look for confirmation. We switch to the 15-minute chart inside our daily zone. We see price make a local false breakout, sweeping liquidity from a previous low and making a sharp reversal impulse upward, with a structural break forming a chalk signal. Following this break, a fresh imbalance zone appears on the 15-minute chart. We set a buy limit order at the upper boundary of this imbalance. We place our stop loss below the local low and target the sweep of the higher daily high for our take profit. The trade plays out perfectly, delivering a 1-to-4 risk-to-reward ratio.
No time for routine work and deep chart study? Earn from the experience of professionals. The automated Forex copy and PAMM services let you copy top traders' positions. Your funds remain fully protected. Open an account with InstaForex to invest and trade like a pro.
Let's move to the second historical setup, a short trade. Step 1. On the 4-hour chart, we spot equal highs where a giant pool of retail stop losses has accumulated. Price makes a strong impulse upward, sweeps this liquidity, and immediately touches a 4-hour bearish order block. All liquidity has been gathered, and the institutional player has fully built their short position. Our higher time frame provides a clear bias. We are strictly looking for shorts. Step 2. Drop down to the 5-minute chart. At the moment price touches the 4-hour zone, it instantly breaks the bullish character on the 5-minute time frame, printing a strong downward chalk signal with a candle body close. During this decline, a clear 5-minute imbalance is formed. We open a short trade from the upper boundary of the imbalance. We place our protective stop loss above the high of the manipulation and set our profit target at the nearest structural low. As a result, we catch a clean move with a 1-to-5 risk-to-reward ratio.
Trading is not just charts, it is a lifestyle. Fund your account with at least $333 within a month and claim premium gadgets, crypto bonuses, or luxury cars. InstaForex offers the market's best prize terms for this.
The third trading setup is a continuation trade. Very often, traders miss the start of a move and don't know how to safely jump onto a moving train. Look at the 1-hour chart. Price has already broken structure and confidently created a new high, a BOS. During this impulse, a large imbalance zone was formed. We understand that the trend is strong, and the market needs to correct into this region to rebalance price before the next push. Drop down to the 3-minute chart. As soon as price touches and fills exactly 50% of the 1-hour imbalance, a micro order block appears on the 3-minute time frame with volume confirmation. We enter a position off this 3-minute order block. Our stop loss ends up so tight that even with a modest trend continuation, we capture an excellent 1-to-3 risk-to-reward ratio without putting our capital at risk.
How to multiply profit with minimal investment. Use a unique deposit format that multiplies your capital on a progressive scale and flexible leverage of up to 1 to 5,000 for large trades. All these growth tools are available only on the InstaForex platform.
Let's break down the fourth example, a classic 5-step smart money model in the crypto market. Step 1. On the 4-hour chart, find a liquidity sweep below a key low. Step 2. On the 15-minute chart, wait for an impulsive structural shift, a chalk. Step 3. Mark the resulting imbalance and bullish order block. Step 4. Place a limit order for a retest of this zone. Step 5. Lock in profit at the opposing equal highs. This algorithm repeats in the market day after day across any asset. To keep you from getting confused during live trading, save this checklist for an ideal trade entry. Point 1. Do you have a clear understanding of the higher time frame trend? Point 2. Was liquidity swept prior to the reversal? Point 3. Is there a clear structural shift, chalk, on the lower time frame? Point 4. Is there an unmitigated imbalance zone or order block available for entry? If your answer to even one point is no, you skip the trade and protect your capital.
Profit from Bitcoin and altcoin volatility 24/7 without complex wallets or buying the coins themselves. The CFD format with leverage allows you to profit from both strong rallies and price declines. You can trade this trending instrument around the clock with InstaForex.
Let's talk about the mathematical edge of the smart money concept. The main difference between this approach and classic technical analysis is the risk-to-reward ratio. In traditional analysis, traders often risk $1 to make $1 in profit. With smart money concepts, thanks to precise entries off imbalances and tight stop losses, your average ratio is 1 to 4 or 1 to 5. This means that even if you are right in only 30% of your trades, you will still consistently grow your capital. Let's summarize our two-part masterclass. Now you possess a complete understanding of the anatomy of price. You know that the market isn't just random candlesticks, but a precise mechanism for collecting liquidity. You know how to read structure, spot institutional footprints through BOS and chalk, and utilize order blocks and imbalances for safe market entries. Stop being the plankton that sharks feed on. Start thinking and trading like smart money.
Protect your money from inflation and crises. Precious metals are a classic tool for capital preservation. Investors choose gold and silver contracts with instant order execution. Click the link below the video and test metal trading with InstaForex.
With that, our foundational two-part masterclass on price action and smart money logic is complete. If this material was valuable to you and opened your eyes to real market mechanics, make sure to hit the like button. Leave a comment telling us which tool felt the most powerful to you, order blocks or imbalances. And of course, subscribe to our channel right now and click the notification bell so you don't miss our upcoming educational videos and market breakdowns. Trade systematically, manage your risks, and until next time.